Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to the webcast. Today's webcast is titled Further Progress Towards Finalizing IFRS 4 Phase II, Transition for Contracts with No Participating Features. Our agenda is always structured around 3 points. First of all, I'll give you the highlights about the discussion that the board completed a week ago on the 23rd of October regarding the transition requirements for non-participating contracts. I will then move into a more detailed analysis of the staff recommendations and the ISB discussion. And finally, unusually from what we do normally, I will take stock on where is the debate on participating contracts, together with the usual reference to the next steps as Deloitte sees them, and an update from our perspective on the timetable. The highlights on the discussion and decisions about transition for contracts with no participating features are set out here, and they are pretty much along the lines of confirmation of what was exposed in the 2013 draft IFRS, with some modifications, one of which is a fairly important one. Let me take you through the key decisions. First of all, the ISB has reaffirmed the conclusions reached in 2013 that there should be a retrospective restatement of insurance contracts at the transition date. And that restatement has to be done retrospectively for all contracts under the IS8 requirements. That full restatement, contract by contract, is only disallowed when it becomes impracticable, as defined under IS8. And we'll talk about that in more detail later on. The second key decision is that if this full retrospective application is impracticable, the ISB reconfirmed that there should be a simplified approach as presented in the draft IFRS last year, but with a modification on the accounting for the risk adjustment. And I will tell you later on in more detail what the modification is about. But essentially is aimed at presenting a better measure of the expected profit at the point of sale of the insurance contract, so there is no overstatement of that key component of the insurance liability. A third decision is that if also the simplified approach is impracticable, the ISB has decided the CSM at the transition date will be measured by calculating the difference between the fair value of the insurance contract that is in existence at that date and the fulfillment cash flows measured for that contract at the same date. The fourth and final decision is that additional disclosures as presented in the draft IFRS last year will be included with the additional requirement of separating the disclosure for the simplified approach and the fair value approach. Let's move into a more detailed analysis of these decisions. As I said on the meeting on the 23rd of October, the board focused on non-participating contracts. There was no discussion this month on the participating contracts accounting model, and instead we have now completed really everything that is possible to be decided on the rest of the universe of insurance contracts. So really is now just the matter of waiting to see when the ISB will feel comfortable enough to take these participating contracts matter to a vote. But going back to the last week's discussion, 3 issues were discussed. First of all, whether an entity should, unless impracticable, apply the standard retrospectively. Second, whether the simplified approach proposed last year should be modified. And thirdly, whether there should be an alternative approach in the event that both the full restatement and the simplified approach restatement become impracticable in the restatement activity of an insurance company. Going through the first issue, the staff presented a paper with a very comprehensive analysis, and I attempted to summarize it in this slide. The staff noted in the paper that there's been widespread support on the 2013 proposal for the restatement approach, and therefore they saw very little need to reconsider that fundamental principle. There is however, a key theme emerging from the response letters, and that is around the operational complexity that would emerge, combined with the concern that a number of insurers expressed in their letters that for particularly old insurance contracts, there could be lack of data, and the requirement as a result of that lack of data to introduce some fairly subjective estimates. The staff analysis also talked about the fact that at transition, some insurers will recognize accumulated losses in OCI because interest rates at the time those contracts were sold were much higher than they are to date. As you all know, many markets around the world are living through an extended and prolonged period of low interest rates, and it is plausible to expect that this financial environment will still be present at the time the new IFRS for insurance contracts will become effective. In that situation, it's possible that as you remeasure the cash flows at the low discount rate yield curve that will be determined by reference to market interest rates on transition dates and compare it with the discount rate that was in place at the sale of the contract, and you are also using the OCI solution for presentation of the time value of money, you may end up booking a significant unrealized loss in equity as an OCI debit reserve. The staff analysis also noted that at the same time, an insurer may also discover that the assumptions that were applicable at the point of sale of the contract have significantly improved in the subsequent periods, and on transition, the CSM, like or like, or even on absolute monetary value basis, could be bigger than it was on initial recognition. If the two events occur at the same time, they acknowledge that this could present an interesting perspective as investors read the opening balance sheet of that insurance company. However, the staff analysis concluded that this approach will actually depict accurately the situation, because the investing losses that would be captured by the debit OCI reserve, together with the underwriting profits resulting in a higher CSM liability component, are just the natural consequence of the economic developments that have occurred between the issue of the insurance contract and the transition date. And therefore, through the application of the rigorous restatement and sufficient level of disclosure, no investor should be misled by these accounting outcomes. The staff also noted in their analysis that as the IFRS for insurance contracts is adopted and these possible consequences reported, it is also likely that the same insurance company would apply the restatement of their financial assets accounting under IFRS 9, and if they have adopted an appropriate similar accounting basis for those financial assets, they could be accounting through the OCI that would mitigate the recognition of a loss reserve with the recognition of a gain reserve on the asset side, given that if you have acquired fixed interest securities, which can be accounted for under the fair value through OCI measurement model in IFRS 9, and those securities were held in place as a backing asset for the insurance liabilities throughout all, or if not all, most of the periods for which the liabilities are still outstanding, then those interest rates will cause an unrealized revaluation of the fair value of the assets, which would be accounted for as a reserve in the OCI. It is understood that the OCI liability and the OCI assets, the two components, could be netted in the same component of equity with disclosure of the relevant entries, but in terms of the reporting, if there is an appropriately matched asset and liability situation, the staff analysis would indicate the compensative effect would not produce any particularly puzzling financial results. Given all these analyses, you will not be surprised to see that the staff recommendation was that at the beginning of the earliest period, an entity should apply the standard retrospectively in accordance with IFRS 8, unless impracticable, confirming effectively the 2013 approach. There were a number of salient points, and allow me to take you through these over the next couple of pages, because we felt that it's quite an important topic, transition, even if it is at this stage applied only to non-participating contracts. And therefore, having the opportunity to take you through all the issues and just summarizing for you the thorough review that the ISB members have conducted on this topic is an important duty that we feel in Deloitte. So the first point is the ISB also supported in a very wide and almost unanimous way the principle that there should be an estimation of the CSM at the beginning of the earliest period presented. That is the key decision that the ISB already took when they moved away from the absence of it in the 2010 exposure draft into the model that was tabled for comments last June. Second point is the fact that a number of board members raised concerns about the operational complexity, the lack of data, the subjectivity, and the extent to which such estimates are auditable. Picking up, of course, on the analysis that the staff made and raising a number of points as to the validation of the ultimate conclusion against these factual and very important material difficulties. Also, the fact that individual insurers could apply full retrospective application for some products and business lines, but not for others, where this is impracticable, was raised as a concern that could create difficulty in the faithful representation of the transition to the new accounting standard. Some insurers may also recognize accumulated losses in equity because interests have materially fallen, as the staff highlighted, since those contracts were initially recognized. There is also the possibility that the lack of equally long-dated assets may create a problem. Negative equity could also result from this decline in interest rates in a number of jurisdictions, and the full retrospective application should be required because of complexity, subjectivity, and cost. Another point that we noted is that full retrospective application will not be able to accommodate the significant diversity of insurance regulations as they evolved over time, particularly the fact that regulators have enhanced the level of sophistication in assessing the level of prudence that must be reflected in the setting of the premiums that insurance companies charge to their customers. And as a result of that, equally risky contracts may have been priced in different ways, not because of economic assessment of the risk, but because of regulatory impositions. And those regulatory impositions, given the long-term nature of the insurance business, may result in a different treatment on transition. Going back on the interest rates, one of the board members also raised the fact that within a particular constituent region, the Asian markets, the long-term government bonds may not have existed for the same durations as the insurance liabilities at the time those liabilities were recognized for the first time, and that could be, again, a problem on the practical application of the full retrospective restatement. When these 2 points, the change in regulation and the absence of long-dated assets, come together, there could be some material unintended consequences. Again, the example was quoted, the negative equity, which could confuse investors. Another point, in this instance, in the opposite direction, in favor of the staff recommendation, was made around the fact that it's better to achieve comparability on transition rather than implement the proposals over the remaining life of the contracts, because of the same reason. The long-term nature of the insurance business require a clear, consistent, and comparable starting point, without which the issues that the standard is trying to cure will continue to persist in the financial reporting environment of the insurance sector. And finally, an important clarification point that came out from the debate, which again we wanted to draw your attention to, is that the interpretation of impracticable is exactly as defined in ISA. There is going to be no dilution of its rigorous application in the proposed standard for insurance contracts. After these extensive debates, where, as you can see, the staff analysis was taken to a significant level of stress testing from a conceptual basis, the chairman called for a vote, and unlike the decisions in the past several months, the majority was there, but not as significant as it was in the past. So only 9 board members voted in favor of the staff recommendation, with 5 voting against it. If this was the situation of the ballot, this would be the bare minimum majority that the constitution of the ISB would require for a standard to be passed and published. Moving then to the second issue, as you remember, having now dealt with the issue as to whether there should be a restatement, the staff tested then the situation of guidance to be provided in the event that the IS8 impracticability situation is detected by an insurance company. So the 2013 draft IFRS proposed a simplified approach. The staff reported that there was widespread support for that. There was an acknowledgement that this is less costly than a retrospective application on a contract-by-contract basis, but there are concerns about the lack of information required under the simplified approach. And so the analysis of the staff indicated that there would be some concerns about the potential for an insurance company to reach a point in time in the past where even the simplified approach becomes impracticable. Another point that the analysis of the staff highlighted is that the simplified approach does not provide results that are fully comparable to retrospective application, but it does provide a close enough approximation that users of financial statements would require in order to have a reasonable starting point under the new standard. However, the analysis noted that there are indeed some issues from the proposals in the 2013 draft, and those were the fact that there will be an understatement at the date of the initial recognition if that amount for the insurance contracts is estimated as having the risk adjustment equal to the risk adjustment at the beginning of the earliest period presented, which is the transition date. And that was a deliberate simplification that the ISB introduced in transition. But this would cause an overstatement of the CSM, and hence an overstatement of the insurance contract liability and an understatement of retained earnings. This could be avoided by adjusting the risk adjustment by the expected release of the risk. So that's what the staff indeed proposed to the board. And so the recommendation is that simplified approach should be retained as a key process for a simplified contract-by-contract restatement of the in-force portfolio on transition date. But that simplified approach should be modified as follows. First of all, instead of estimating the risk adjustment as it is measured on a current basis on transition date, the insurer should be required to estimate the risk adjustment as it was computed on the initial recognition date of the contracts in force on transition. And that re-estimation should be done on a simplified approach basis, and that is by taking into account the measure of a new contract issued on transition date with the same characteristics as the contract that we're trying to restate, and then based on this similar contract on transition date, the insurer will be required to calculate the release pattern of the risk adjustment as estimated on transition date, and then apply retrospectively the release pattern for those risk adjustment liabilities to take the restated risk adjustment on transition back to what it would have been its value on initial recognition. So that is, in other words, adding back to the risk adjustment liability on transition date the expected release of risk determined by reference to similar insurance contracts that the insurer issues at the transition date itself. So if I take an example of a 10-year contract and we have to restate a similar contract that has already carried forward for 5 years its protection, that means that we have a risk adjustment that after 5 years could be of a smaller amount as a result of the insurer having been released from the risk of paying claims for the past 5 years. So what the standard would tell us to do if this contract was restated under the simplified approach is that we measure the risk adjustment on the 1st of January of the transition date. We calculate that for the 10-year contract. We see what is going to be the release pattern that this risk adjustment will follow over the next 5 years and obtain this figure. That will tell us that, for example, the risk adjustment in 5 years' time should be reduced, is expected to be reduced by, say, 40%. And so what the insurer would then do is to increase the risk adjustment by an equivalent 40% in order to bring it back to the same amount that was expected to be in place on initial recognition. So if after 5 years the risk adjustment is 60% of the initial recognition, the restatement adjustment under the simplified approach will be to divide the 5-year contract risk adjustment by 0.6 to gross it up to what it would have been a like-for-like risk adjustment on point of sale. Very little discussion about this recommendation and unanimous vote in favor. So it's something that we all need to be a bit more familiar with now as we prepare for the implementation of these requirements. Moving then to the third topic, the situation here of a simplified approach and a full restatement both being impracticable. What the staff proposes in the analysis is that a fair value approach would apply when both the full restatement and the simplified approach are impracticable. It may be the situation one that arises from the lack of cash flow information. Cash flow information, for example, around expenses or acquisition costs, or sometimes even premiums. In those situations, a fair value measure should be adopted. That was the conclusion that the staff reached. But they highlighted the possible disadvantages that this will have. First of all, there will be some reduced comparability, of course, because fair value is not the same as the restatement. And there is also the potential risk of overstatement of future revenue, given that this fair value approach will be used to very old contracts. Nevertheless, the staff concluded that it is always possible to estimate the discount rate, and therefore, in the fair value approach, the discount rate point estimate will be taken into account, and we'll see in a second in the recommendation how we should work through the calculations. So when we look at the recommendation, we can see that the fair value approach is going to be used when impracticability is passed under the two restatements. So full restatement is not practicable, simplified approach is not practicable. Those contracts are excluded from the fair value approach, and whatever is left is then fair value. That means that you calculate the building blocks approach value of those contracts. You determine their fair value at transition date, 1st of January of the opening comparative period, and then you take the difference between those two numbers as the CSM for those contracts. That gives you the CSM that should be reported in the opening balance sheet. That's where the discount rate calculations comes to play, because you need that to calculate other numbers in terms of the restatement. One is a requirement, and that is the accretion of interest on the CSM, which is based, as we know, for non-participating contracts on the locked-in discount rate at inception. The other one, which is an option, if you are choosing the OCI presentation for interest expense, then you need to have, again, the locked-in discount rate at inception, at the point of sale, to calculate the OCR reserve. And so what the staff recommended is that the discount rate using the existing simplified approach calculation will be part of the fair value approach. So fair value approach for the CSM is one thing that is new, but the use of the extrapolation backwards of the discount rate, that remains applicable both to the simplified approach and the fair value approach in the restatement. And this discount rate will then be used on a compulsory basis for the accretion of the retrospective interest rates, interest expense to the transition date of the CSM, and also to calculate the OCR reserve if the OCI accounting policy election has been made. The salient points that follow this analysis and recommendation are summarized on this slide. First point actually was a response from the staff which answered a board member question, noting that the CSM will not be based on the premium that had been charged for the contract. So that's one of the key features of this fair value approach. Premium is alleged to be a lost piece of information. And that could be also an example of how to test whether the fair value approach should really be used, is if you have some key cash flow information being missing and it is impracticable to retrieve it. The second point was that the discount rates will not be known in those countries where only short-dated government bonds were available many years ago. And this is, again, the same board member that talked about the characteristics of those insurance markets in Asia. They made, again, the point about the lack of data. The staff stated that in such circumstances, the yield curve would have to be extrapolated. Another point was that allowing three different approaches to transition within the same insurer would hinder comparability. And that is a valid point, given that the staff analysis itself highlighted that the fair value approach disadvantage is indeed a potentially reduced comparability. However, there is a need here to consider the fact that having a restatement contract by contract is an important matter. Having the outcome of that restatement contract by contract is an important goal, and this is what the staff is attempting to achieve, using three different methods, but all of which will still deliver a contract by contract restated opening balance sheet with the CSM being calculated as comparatively as possible with each other. Last point on this slide is that insurers may try to justify using extensively this fair value approach, as it may be attractive in respect to the recognition of future profits, and also because its implementation cost may be calculated as lower than the full restatement cost or the simplified approach cost. So the staff was noting that clearly that is a possibility, but there are very reputable auditors around which will challenge management if there is not a truly honest application of the impracticability assessment. And so the board members were satisfied that this is a possibility, but the strength of the audit profession should be a sufficient enough barrier for that. So coming then to the last components of this final part of the 23rd of October discussion, the recommendation on the disclosures that could go hand in hand with the three methods. For each period presented, the staff recommended that there should be disclosure for both the simplified approach and the fair value approach of the information that was set out in the 2013 exposure draft, and that disclosure should be separated for the two non-traditional restatement approaches, the simplified approach and the fair value approach, so people can actually see for each of the two non-canonical methods how much is involved in the restatement and form their own views. Both these sets of recommendations were put to vote by the chairman, and the vote was 11 ISB members in favor and 3 against. So not as strong as the modification and simplified approach, which was unanimous, but much better than the principle of full restatement, which saw a 9 against 5 majority. So that concludes my report back to you on the 23rd of October meeting. Let's now take stock, as promised, on the participating contracts. So what's going on? There is no discussion this month. Is the process delayed? Well, it is. And the ISB is of the view that it's a very material decision, the one that they have to take, and therefore they need to take more time in order to make sure that they understand all the points of view, that they can digest them, and therefore can move into a voting stage on this topic with the benefit of a full briefing and a full understanding of the issues associated with it. So it's important that now that we know that we are looking at a bit longer on the completion activity of the redeliberation phase of this project, it's important that we understand where are we on the discussion. So first of all, we are in a situation that is unlikely to bring back into the final standard the mirroring approach that was published last year. This is because the ISB has acknowledged that there's been a wide rejection by the constituents, and so it's not worth a while for them to bring it back into the final standard. The real issue here is that several commentators have directed the ISB towards using the building blocks approach, the BBA, with some adaptations to reflect the nature of the participating feature included in these contracts. And in particular, the fact that policyholders' cash flows will incorporate a portion of returns generating from underlying items that the insurer holds. The ISB accepts that this feature may be present in insurance contracts as well as financial instruments. So we're coming from a position which was validated in the exposure draft and voted last year, that this accounting model applies to insurance contracts as well as financial instruments, but only when this participation is discretionary. So where are these adaptations going to be affecting the building blocks approach? There are primarily two areas. The first one, and in my personal opinion probably the most important of the two, is in the adaptation of the unlocking of the CSM, which could take into account the changes in the insurer's future share of return generated by the underlying items. Obviously, in that adapted unlocking model, there should also be a profit recognition basis that should be mindful of the additional component that comes into the equation of unlocking. And so that principle of profit recognition should be refined and defined in a different way. The second area is the very important presentation matter of what is going to be the interest expense that the unwinding of a participating contracts discounting would produce in the profit or loss of an insurance company. And here the ISB appears to have now reached a kind of a situation where they would be likely to vote on presenting the time value of money separately between profit or loss and OCI, using an asset-dependent yield that is based on the projected crediting rates rather than the market-consistent discount rate curve, which is set out at the initial recognition point of the accounting. So this will be an adaptation to the OCI solution decision that the ISB has reached already for non-participating contracts. In the event that the ISB accepts these adaptations, it would then become critical for them to consider the scope of application of these adaptations. That's why I drawn your attention earlier to the fact that we are coming from a scope which is defined as explained earlier, but this may not necessarily remain the same if the recognition and measurement is adapted along the lines described above. Now, as I said earlier, there is a decision at the ISB to listen more intensely to different points of view, and in particular, we are now being informed that the European CFO Forum has proposed a new educational session on their alternative model for participating contracts, which has incidentally been welcomed by a number of constituents. Among those, I just want to remind there was the European Financial Reporting Advisory Group, who said in their response letter, but also in the contributions given during the Accountant Standards Forum, that they are positively supportive of this approach. And this alternative model is expected to be described as a conceptual model applicable to all participating contracts. We understand that the CFO Forum will define participating contracts as those contracts that offer a variable return linked to a specified pool of assets, irrespective of whether or not the actual assets are held by the insurer. This scope would be broad enough to capture most, if not all, of the European-style, Asian-style, and American-style insurance contracts. The scope will also capture a portion of contracts that have no insurance risk transfer, but where the variable return includes a discretionary element derived from the underlying items held by the insurer. So that is essentially copy and pasting the decision that the IASB already reached and saying that it would be part of the alternative approach recommended by the European CFO Forum. In terms of the recognition and measurement proposal, the key features are four. First of all, no bifurcation of the cash flows, single discount rate curve for all cash flows, so a building blocks approach without the split of cash flows that the mirroring wanted, so along the lines of what the majority of the commentators recommended to the IASB. But interestingly, the European CFO Forum proposed a single discount rate for all cash flows, whether they are asset dependent or not, for balance sheet measurement. In the P&L instead, there will be a book yield rate, which is derived from the accounting basis of the assets that are affecting the variable return described earlier, and that will reflect to P&L the time value of money. If there is a difference between the book yield and the balance sheet, that difference is the one that will flow then into the OCR reserve. The third feature is that the CSM would be defined as the insurer's share of future profits from the underlying items with full unlocking of all variables, including options and guarantees. And so this makes the unlocking adjustment similar to the one that the IASB has been considering in their education sessions in the past several months. Finally, the profit recognition will be based on the delivery of the service to the policyholder, which appears to be a sufficiently broad principle to allow the diversity of the various forms of participation to be accommodated within this alternative model. So this is what we expect to hear the CFO Forum present on the educational session, which we understand is scheduled probably on the 14th of November. At the moment, there is an educational session penciled on the 14th, but also on the 13th. So there are two possible dates. Our understanding is the latter, the 14th is the likely day, but we may be proved wrong. So take this with the benefit of the fact that it is an estimate of Deloitte. If these educational sessions gives the necessary comfort and confidence to the IASB that they've now analyzed all the possible angles of the issue, it may actually end up resulting in a declaration that the preparatory activity started in May is now completed. So the IASB may move in decision-making sessions thereafter. There is a board meeting on the week commencing the 17th. So technically, they could start on that month. I frankly believe that it's unlikely because the education session is too close to this board week. So we may end up having an agenda for the board meeting in November without insurance, given that all the other topics have now been decided and participating contracts is still being presented on an educational basis only. It may be that the November board meeting on the week following the education session being received will feature no insurance contracts items, but we'll see and react accordingly in terms of keeping you up to date. Lastly, is to remind you that once these decision-making sessions begin, there will be nothing else apart from reassessing any of the prior decisions for non-participating contracts against the final decision that the IASB will have reached on participating contracts, and at that point, given that the full model will be in front of their eyes, to really decide when the effective date of the proposed standard is going to be. Just remember that the IASB remains committed to their approximately 3 years gap between publication date and effective date. So if we are measuring approximately with the idea that it has to be more than half year, as we push the redeliberation phase beyond the end of this calendar year, it is plausible to envisage a publication date in the summer of next year, and an effective date that could be chosen at the 1st of January 2019 rather than 2018. That would have a number of consequences. One which could be seen as positive by a number of insurers: more time to prepare. Is going to be 3.5 years. That's a pretty good period to prepare for such a major implementation. The other one, which may not necessarily be a positive one, and that is that it will not be aligned with the effective date of IFRS 9. And given that a number of regulators, including the European Union, have said that they would like to have the two aligned, it remains to be seen whether that pressure will have any bearing on the IASB decision. So this is the situation that we are contemplating right now. Completion of the decision-making sessions earlier in 2015, with a publication sometime later in that year. Our guess at the moment is probably in the summer or late spring. That is all I have for you today. I would just like to remind you that the webcast will be uploaded in our website, and you can see the link address on the last slide. And with that, I would just open the floor for any questions you may have after Courtney has stopped the recording.